Welcome back, everyone. Michael here with Offshore Citizen. I have had some people ask me over the last little while what my current thoughts are on sort of the state of the economy and investing. And of course, on this channel, one of the things that we talk about every now and then is a bit of macroeconomics and a little bit of investing. So I'm actually going to do a separate channel entirely devoted to that subject. But in the meantime, I figured I would give you some of the information that I've been sharing with friends and business partners, etc., over the last month and a half, something like that, so you can have an idea of at least what my perspective is on where we're at and what that might mean in terms of the best selections for the next, 6 months, a year, 2 years, somewhere in that time range. So let's dive in and talk about it today. We're going to cover lots of interesting things. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Thank you for being here on the channel. Normally, the main thing that we cover is international tax optimization, relocating to other countries, passports, citizenships, global banking. If you're interested in any of those things, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message through offshorecitizen.net. Okay, so macroeconomics. I think it's maybe worth giving a little bit of a recap on what I would view as the important factors to be thinking about on a very macro level, okay? And hence, might give some indicator. Now, before we talk about that, though, I want to talk a little bit about sentiment. So for the last, since maybe spring of 2022, there have been all these calls for a recession. Now, generally speaking, what the majority thinks will happen does not happen. So generally, you're usually best betting against what people think instead of what they do. For example, somebody sent me a report the other day forecasting a 10% earnings per share increase in the S&P 500 over the next year. Just facts, and the reality on this is that every year, all sorts of these investment banks make these kind of projections, and they are always dismally wrong. So the best thing to do is probably actually to bet against them rather than with them. They're not very good at doing their job, but it's good research for selling whatever. Now, this brings me to the fact that we've gone through a long period of time of people expecting a recession and a recession not really happening. Yeah, you can make an argument, okay, there was 2 negative quarters of GDP, but it definitely didn't affect kind of the working class people. Definitely certain financial assets went down a lot, both bonds and stocks. Again, not something that affects kind of the working class in a real way. The actual economy itself has sort of continued to chug along well. People have generally done well, etc. Also worth noting was I made some predictions at the start of the year, one of which was sub 5% inflation rates by the summer. And look, we're at the summer and we're well below that. We'll talk about that one in a minute. So with those kind of things in a bit of context, let's go and look at the broader context, which is how do we think of macroeconomics? And macroeconomics, I think, is fundamentally people get they tend to focus on indicators and little things here and there, which, those are symptoms. Symptoms, can be useful as something to pay attention to what's going on. But generally speaking, the broader picture is how much supply of money is there out there? Where is that money flowing to? So volume of money, flow of money, and then the volume of assets, okay? That's typically the 3 things that we're mainly thinking about when we're thinking about macroeconomics. As we know, during COVID, what happened? The central governments and the central banks flooded the market with money, and what did you see? You saw things go up a lot, right? The volume of money went into the market pretty aggressively, and you had sort of the everything bubble, so to speak, right? Now, this being said, what has happened now is there has been an increase in interest rates, pretty dramatic one, right? We're over 5% now. At the same time, we're in a situation where government deficits have increased quite a lot. However, we don't have the stimulus that came during COVID, so that's something. And you definitely have sort of more or less the same amount of stocks in terms of those assets, definitely a lot more crypto projects. And in terms of bonds, there's QT, so as opposed to QE, and so that's having an effect on having maybe more bonds in the market than there was on a relative basis before. Okay, so we're always talking relative to the volume of money. So I think from a monetary standpoint, if we just sort of break this down, we say, well, we've got volume of money. How do we determine volume of money? Well, the volume of money comes from two places. It comes from government deficit spending. So when the government spends money at a deficit, it creates money into the private sector, okay? And government deficits have continued to rise, or rather government debts have continued to rise. The deficits are certainly high. As the debt service costs go up, you're seeing more and more in the way of government service costs, which drive up deficits further, okay? And this is, kind of fairly predictable. You have over 100% debt to GDP that is out there. You've got servicing costs that are going up because interest rates are going up. And so that's going to mean governments have larger debts, and as governments or deficits, and as they have larger deficits, that means more money into the private sector. That money then gets absorbed by whoever those parties are receiving it, and then they have to do something with it. They're going to spend it on goods of certain services, or they're going to put it into financial assets, or they're going to save it in cash, right? Okay. So that's sort of our tapestry of the one side of it. The second side of it is you've got a situation where you have bank lending, okay? Now, if you look at the Fed data across all commercial loans, what you're actually going to see is that it's kind of continued to rise fairly normally, nothing crazy. However, certainly in some sectors, for example, in mortgages, the lending has gone down a lot, and it's hard to kind of break out some of the specifics of some of those areas. Certainly, the ability to afford the debt that is out there, the ability to do things like have margin loans, et cetera, has certainly gone down. Right? And that's simply because of the fact that if it's costing you in excess of 5% to borrow money, whereas before it was costing you 1% to borrow money on a margin loan, well, you can just borrow less of it, and it's more risky to take on those loans, right? So in general, as they raise interest rates, this tends to have a contractionary effect on private lending, okay? It's not entirely true, but it's one factor for sure. So on the one hand, you have volume of money going up. On the other hand, you have volume of money going down. These two arguably probably are similar to equalizing each other. Some of the numbers that have been put out by Warren Mosler, who's one of the few people who I would say has been right about what's going on here, is that between the increase in debt service costs for the central government as well as the central bank, because they pay interest on bank reserves, between those two, you've added about $1 trillion a year from a US perspective going into the system, okay? How much have you pulled back lending? A little harder to calculate, but there's some reason to believe that that's somewhat offsetting each other. It's not massively in one direction or the other, contrary to what some people would believe. So a really important thing here to understand is that there was a mental model a lot of people had based on the 70s when the Fed had raised interest rates quite dramatically, and that had closed things off. One of the big differences that took place was back then you had 30% debt to GDP. Now you have in excess of 100% debt to GDP. So when you raise the service costs of interest in the central government, and they have 30%, the relative amount of money that they're adding to the economy through those higher debt service costs is a lot less than when you have in excess of 100%, okay? So really important to understand that this is creating a different dynamic from what we've seen historically. Now, then we come to the flow of money, okay? And the flow of money is really important. This is probably one of the most important things that we're going to discuss here. So essentially, Stanley Druckenmiller made an interesting comment about the start of his career. For those of you who don't know, Stanley Druckenmiller is probably top 3 or so most successful at-scale fund managers in history. He had just a phenomenal 30-year track record running a fund in excess of 30% a year on average, virtually no down years, like just really phenomenal record, okay? The only one who really notably, I would say, is better than that is Renaissance Capital with their automated algorithms and great stuff for them. So, a smart guy, you should probably learn a few things from him when we're talking about investing. And he said when he got his first job, he went out and he did a whole bunch. He was asked to do some research, and he came back with all this fundamental research. He gave it to his boss, and his boss said, great, what does this have to do with the price? And he said from that he learned that fundamentals don't move price, liquidity moves price, okay? So why something goes up is because more capital is flowing into it than is coming out of it. That's the bottom line. Now, there might be psychological reasons and narratives and incentives for why that money is flowing in or out, but fundamentally, you're thinking about where is money flowing to. So we have more or less equal amount of money, where is it going? And the answer is that money tends to chase yield, okay? Now note chase, because it means it's behind the ball game. In other words, things happen, yield tends to show up first, and then the money comes in afterwards trying to pursue that yield. Now when I say yield, I'm not necessarily referring to cash flow yield, I'm basically talking about returns. And note that this is on a risk-weighted basis, so the flow of money can change quite a bit if you impute a risk variable. So a good example of this was earlier in the year, you had the banking crisis in the US. What happened? A lot of money fled banks and went into money market funds, into bonds, into Bitcoin, etc., for a kind of flight to safety thing. So you had similar conditions, but you imputed a new risk variable that caused money to flow a certain way. You can also impute various growth variables, for example, what happened with NVIDIA's stock earlier this year with AI, et cetera, okay? But in general, we're thinking about, okay, money will flow to where it's going to get the highest return on a risk-weighted basis. That's loosely it. And what has happened for sure is that as interest rates have risen, the hurdle rate for everybody else has gone up. So you were getting zero return basically on money held in a bank. If you have an account at Interactive Brokers now, they're paying you like 4.58% or something, just to have your cash sitting there doing nothing. And so you have to mentally think, well, if I go and I make an investment, will I do better than 4.58% with comparable degrees of risk? Because that's my hurdle rate right now. And this causes a lot of different things to reprice. So clearly, I kind of mentioned again at the start of the year, the first asset class this really hurts is commercial real estate. Commercial real estate, especially when you're talking like AAA commercial real estate, is very much priced based on bonds. They're kind of saying, okay, I could buy a bond. It's obviously simpler if you're a big fund or something to buy a bond than to buy real estate. And so if you're going to buy real estate, you want some premium over what you're getting in the real estate. If your cap rate was 3% and bonds were paying 2 or something, that might make sense. But when bond rates rise, now to be fair, bond rates haven't risen up to the Fed funds rate in most cases, although it depends on the term of the bond and things like that. But a lot of them haven't. Certainly the long end of the bond curve has not. When that happens, you're looking at this and you're saying, okay, well, maybe I should just not have the real estate and instead have the money in bonds. So what are you going to do? You're going to sell the real estate. That's downward pressure on real estate. And you're going to buy the bonds. So that's upward pressure on bonds, right? Decreases the yield, but increases the price of the underlying asset. So you're like, okay, well that kind of gives me some sort of a context for real estate. What about other things? Well, at this point in time, we haven't really seen a massive correction in equities, which is interesting, right? You can see that the S&P 500 is very high, the NASDAQ is very high, et cetera. What explains this? And I think the first thing that can be explained is if you look at a breakdown, what you're going to notice is the so-called Magnificent Seven. So basically a few mega caps, so Microsoft, Google, Apple, Meta, et cetera, have had this extraordinary run up, and they're heavily weighted within the index, and that's pulled the whole index up. But across the majority of the index, actually it hasn't moved very much. It's still down a bit from where it was before. And so that's kind of something kind of interesting. You can ask, why did that happen? Now, in my opinion, this is probably a flight to quality. And I think in general, what we're seeing is a rotation to quality. So historically, interest rates were very low. It was a low hurdle rate. You were paid to bet on something was going to go up. You were in a situation where the cost of capital was really low. That fueled valuations in high growth, negative profit margin companies. But now the service costs on those loans are higher. The access to new capital is much limited, and they're going to be refinancing a lot of that debt. And as they refinance that debt, a bunch of them are not going to be able to afford it. They're going to either not become profitable, they're not going to be profitable anymore, or they're going to go bankrupt. And neither of those things are really great. So hence, what do you start to look to? You look to profitable companies that are super solid. Microsoft isn't going to have a problem. Apple isn't going to have a problem. Google isn't going to have a problem, et cetera. And so in addition to kind of the AI stuff, et cetera, you've seen this flow of money into those types of assets that's driven them up relative to assets that are carrying high debt, that are much more capital dependent, that aren't profitable, et cetera. Okay. Now, yes, coming off of, say, December lows, a bunch of things are up a lot, but if you look kind of compared to 2021, they're still down a lot, right? So you kind of have to kind of look. It's like you have this mean reversion that to some extent has taken place here. So very important to consider those factors. Now let's talk a bit about inflation for a second. So as I said, I've been saying for a very long time, inflation is coming down. It's going to be sub 5% by the summer. There were people in the comments who are like, haha, yeah, right. Well, go and take a look. It's sub 3% or around 3% now in the summer. And by the way, just like to understand how that worked, it was a really simple prediction. It wasn't, you didn't have to be a rocket scientist, you didn't have to whatever. You could simply understand the roll-off effects. So I may make a video on this in the future, specifically about understanding inflation. But the thing that you have to realize is each month, you only have 1/12 of the overall calculation changing, right? Because all the previous 11 months have already been calculated. So you know exactly what those are. So if you're at, let's just say 7% inflation, and that was calculated over a 12-month period, then the next month, how much can you change? It's not going to be that much. It's basically just based on, you can look at what was the last, let's say we're going from January to January, what was last January? Was it high? Was it low? What's it likely to come in here? And that's going to tell you. And so what I saw, how I was calculating this, was I just said, it looks as though inflation has more or less equalized. We don't have to see major drawdowns. You can make arguments for, food, fuel, what are these things going to do? Yeah, there's, used cars are going down. Like there's certain things that are going down. There's certain things that, could be a little bit more volatile, could be a bit more sticky, etc. You don't need to really worry too much about that because it kind of cancels out. And you could see in the data that on a monthly basis, it was coming in pretty flat. Maybe it's 0.2, maybe it's 0.4, etc. And you had a few months in there, 3 months in particular, where you had really big inflation spikes. And so all you have to do is calculate, well, if those roll off and normalize, where does that take you? And the answer was it took you sub 5%, which we're at today. However, all of that roll off is done, okay? The last major roll off just happened. And so now you don't have any major roll offs. So the only way that we can see meaningful moves in inflation data to the downside at this point is if we start to get month over month, basically monthly declines, right? If we get actual deflation, which is possible, it's not an impossible thing, then you could see that. I think that's much less likely to happen. I think it will be a much slower process at this point in time. We've gotten rid of most of that and we're kind of normalizing. So will we go down a little bit? Yeah, we might. Will we go up a little bit? We might. It's much harder to say. It's going to depend a lot more at this stage on fuel prices. I think that it's not really very clear in the short run that there's going to be a big catalyst for fuel prices to go up a lot. You're in a situation where realistically, what you can see is that demand is down in China. There's some signs of the economy cooling. I'm going to talk about that in a second. And people are, at the point where they've sort of burned up the COVID cash, so travel, et cetera, demand, not really there. War in Ukraine doesn't seem to have caused anything serious, lasting, that's going to cause issues. Probably you're looking at fairly stable supply, and the price of oil is very supply side focused, with occasional abnormalities on the demand side, such as we had during COVID when we had negative $34 a barrel, what it was, or WTI or something like that. So realistically, it's probably not going to vary that much. Could vary somewhat. I mean, will obviously vary somewhat. That's something that's going to happen, but it probably won't vary that much. And so my guesstimate would be inflation will probably remain fairly steady where it's at. You have a little bit of upwards wage pressure, but if you look at the data on that even, you're not seeing the high wage pressure upwards that you saw before. We're just kind of seeing a normalization. What does this mean for interest rates? I mean, I think it's really difficult to predict interest rates because contrary to what a lot of people see, I see a bunch of people who, they try to look at it as though the Fed acts mechanistically. The Fed does not act mechanistically. You could have extremely low inflation and the Fed could hike rates, or you could have high inflation and the Fed could choose not to hike rates. Like, they have that choice. They have kind of like, they're not irrational, they're not, totally nuts, so they're not just behaving randomly. But that being said, they're not, you can't have like very precise calculations. My guess would be that they're looking at the data and they're saying, core PCE, which is one of the main things that they look at, has not come down far enough. We don't see that the economy is on the verge of collapse. In fact, what we're seeing is the recession indicators are coming down. The labor market may be cooling slightly, but we don't have sustained signs of that. We're going to keep inflation, or we're going to keep interest rates approximately where they are. Maybe we're going to raise, another quarter point or something like that. Maybe we stall, but we're probably more or less where we're going to be for the next little while. That would be my guess. Now, this comes to a couple key points, okay? The first key point is, as I said, recession. People were talking about, we're going into recession, we're going into recession, we're going into recession. When everybody's saying you're going to do it, it's probably not going to happen. Now, everybody's saying, hey, we're going to have a soft landing. So I basically went from when everybody was saying we're going to have a recession, I'm like, I'm not too worried about a recession, to now I'm hearing lots of talks about a soft landing. Now we can start thinking about a recession. Now, do I think that we're going to have a recession immediately? No, I don't think so. However, I think that there is a reasonable chance that we see the economy cool. You see some sort of a slowdown late this year or first half next year, I would say. Now, humans are inherently bad at timing, so I would say, stretch that out and expand the area because, timelines are tough to predict. But essentially, what would be the catalyst? The catalyst would be this refinancing of debt, okay? So the big concern, I think, right now is you have a lot of companies that borrowed very cheap money during COVID, and now interest rates are 5% or so higher than they were before. And now all those companies are going to have to refinance their debt at least 5% higher, basically. And suddenly this is going to increase their debt service payments, right? That's going to eat up their cash flow more. It's going to decrease their profitability if they have it. You're going to have margin compression. That's not going to be good. And this is going to force a bunch of companies that are unhealthy into bankruptcy. We still haven't seen, one of the things I'd predicted was that we would see a bunch of bankruptcies. I think I'd predicted that it would happen lots this year and into next year. We still haven't seen that much of it. And so I would expect that we're going to see quite a few more bankruptcies over the next 18 months or so. That would be my guess. And that's just it's imputed by the fact that you're having this debt roll off. Another consequence of that is you will probably see less borrowing, and you will see less wage increases, and you will see more layoffs. Combine this with the second factor, which is essentially what happened during COVID. During COVID, you had goods shortage. Goods shortage meant that prices went up and companies could afford to charge more. Now, there was a latent effect where supply chains started to normalize, so companies had supply, but they also had their high prices. Well, we've basically gone through that cycle, and now we're on the back end of that cycle. So it takes a long time for this to clear out. And that's one of the lessons I think you can take from this is it just takes a long time for these things to play out. But now we're at the point where basically supply chains have normalized. You can look at it, for example, in the vehicle business. I have some business there. And you see, all the options, dealerships actually have vehicles. There's like a wonderful concept. Second of all, they're bringing back the incentives. You've seen already Tesla kind of led the pack in slashing prices, but they're going to slice. So what you saw was basically corporate profits went up quite a lot, which meant it looked like price to earnings ratios were pretty reasonable. And that was basically based on margin expansion. There's kind of some talk about, hey, inflation was caused by corporate greed. It's not corporate greed, it's the fact that when you have a scarcity of goods and people competing for it, you can raise the prices and make that work. I think you're going to have the backside of it now, where you're going to have margin compression instead of margin expansion. Profitability will come down. You can see, for example, two indicators in the travel industry. One is Ryanair has said the market's looking a little bit softer than we were thinking. We're going to have to slash prices. If you've been traveling, you can see over the last couple of years, prices went insanely up for airline tickets, for hotels, et cetera, way above what they were pre-COVID. Another is Mediterranean tourism was down about 10% year over year this year. And so I think you're kind of seeing the signs that people feel like, hey, things are a bit too expensive. I'm not going to do that so much anymore. So I'm backing off as a consumer. In addition to this, the kind of excess cash that they had that they were going to spend from the COVID times, they've spent that. That stuff's all worked its way through. So now what we're essentially in the phase of is normalizing. And what normalizing is going to mean is that margins come down. when margins come down, when they're forced to discount, all this sort of thing, that's going to mean layoffs, which means when people get laid off, then there's less people to spend, et cetera, et cetera, et cetera. So that whole cycle, I expect to result in a slowdown. Probably, again, like I said, late this year. I would guess first half next year, but it could take longer, and I could be completely wrong. But this is sort of my frame of what I'm thinking about. I do not think you will see the Fed cut rates unless you see like a deflationary environment where they say, whoa, we've really overshot, which they probably have overshot, by the way, or you see the economy take quite a hit. And I think that at least for the next several months, or a few months, et cetera, I don't think you're going to see a major hit to the economy. So you've probably got a window of time where that's just where you're at, Of course, the Fed will pause, sometime soon, highly likely, unless you see some new spike in inflation, and it's possible from kind of a random event, but not super likely. And so I would expect that most of the gains in a lot of these assets are done. I told my brother, whatever it was, 2 weeks ago or something, I was holding NVIDIA, done very well on it. I was like, if I was you, I would be taking profits on it. I think, a lot of those things have probably topped out, and you probably won't see a lot more upside. You may see a rotation to smaller caps and things that kind of haven't flown yet. The healthcare sector, for instance, hasn't flown yet. I've been buying some things there. It's possible that it won't, but we'll see. There's, I think, some reasonable chance that it could. And so my view is that, yeah, you'll always have variations within there. There's some up, there's some down, but not massive moves up and not massive moves down. That's my kind of working thesis. And as a result, the main thing to pursue in that situation is a cash flow strategy that essentially you get compensated for holding whatever. And therefore, if it doesn't go up, no big deal, you're getting money for holding. And if it goes down, hey, it's still paying you money for holding, and you can afford to kind of wait through whatever the other time is, as well as you can use that cash flow to buy in on assets that are lower. So that's sort of my kind of macro view of what's going on at this stage. Let me know what you guys think. Put it in the comments below, and I will look forward to seeing you on the next video.